Welcome to InvestorWeb, your go-to channel for insightful investment tips and financial advice. Today we're diving into a topic that's often misunderstood, yet holds immense power in shaping your financial future. We're talking about leverage. You've probably heard this term thrown around in investment circles, but what exactly does it mean? In its simplest form, leverage is using borrowed funds to increase your buying power in the hopes of amplifying your returns. It's like using a lever to lift a heavy object. A small effort can lead to a big move, but with every reward comes risk, and in the world of investing, these risks can be significant. Many have been lured by the promise of high returns only to find themselves in a financial quagmire. Today, we'll explore the top 10 ways people go broke with leverage. Buckle up for an insightful journey. The first way people go broke with leverage is by misunderstanding it. Leverage, in financial terms, is like a double-edged sword. It can amplify both your gains and losses. When used wisely, it can multiply your profits, but when misused, it can plunge you into deep financial trouble. To put it simply, leverage involves using borrowed money or financial instruments to increase the potential return on investment. It's a strategy that's used by many investors, from individuals to large corporations, but it's not without its risks. The problem arises when people jump into using leverage without fully understanding its implications. They see the potential for big profits and ignore the equally real potential for significant losses. Leverage, like any financial tool, requires knowledge and careful handling. Misunderstanding leverage can lead to making ill-informed decisions, which can in turn lead to severe financial losses. As the saying goes, a little knowledge is a dangerous thing, so a lack of understanding of leverage can lead to severe financial losses. Another way people go broke with leverage is through overtrading. Now, what is overtrading, you may ask? Well, it's a situation where an investor, in a flurry of excitement or panic, makes more trades than their strategy or budget allows. It's like being in a casino, betting on every roll of the dice. You might win a few times, but the law of averages is not on your side. When you combine overtrading with leverage, the stakes become even higher. Remember, leverage amplifies not just your potential gains, but also your potential losses. And with each trade, you're not just risking your initial investment, but also the borrowed capital. So, if you're constantly trading, the losses can pile up quickly, leaving you in a financial hole before you even realize it. That's why it's crucial to have a trading plan and stick to it. Overtrading, especially with leverage, can quickly deplete your investment capital. Not setting stop losses is a common way people lose money with leverage. This might appear as a mere oversight, but it's an error that has led many investors down the path of financial ruin. So what's a stop loss? Picture it as a safety net. When you're using leverage, you're essentially borrowing money to invest. This means the potential for gains is magnified, but so are the losses. A stop loss is a predetermined point at which you decide to sell your investment to limit any further losses. Imagine you're climbing a mountain. The higher you go, the harder you could fall. A stop loss is like a safety rope. It won't prevent the fall, but it will stop you from hitting the bottom. Setting a stop loss is a critical strategy when using leverage. It allows you to manage your risk, protect your investment, and more importantly, it prevents small losses from becoming catastrophic ones. Without stop losses, losses can multiply quickly and lead to financial ruin, so remember, always set your safety net. Poor risk management is another way people go broke with leverage. When we talk about risk management, we're referring to the process of identifying, assessing, and controlling threats to an organization's capital and earnings. In the world of investing and trading, risk management becomes even more critical. You see, leverage magnifies not only the potential profits, but also the potential losses. Now imagine if a trader, lured by the prospect of magnified profits, throws caution to the wind and takes on too much risk. When the market moves against them, the losses can be catastrophic, wiping out their initial investment and even putting them into debt. Poor risk management can be as simple as not understanding the market, failing to set stop losses, or ignoring warning signs of a market downturn. It's a bit like driving a sports car without a seatbelt at night in the rain. Effective risk management is crucial when using leverage. Lack of diversification is another common way people lose money with leverage. Now, you might ask, what's the big deal about diversification? Well, it's like not putting all your eggs in one basket. If that basket falls, you lose all your eggs. Investing in a single asset or sector can be risky, especially when using leverage. Diversification, on the other hand, spreads your investments across different assets or sectors. This way, if one asset or sector performs poorly, others may perform well, balancing out potential losses. It's a fundamental principle in investment strategy, aiming to maximize returns by investing in different areas that would each react differently to the same event. Now imagine using leverage without diversification. You're basically multiplying the risk associated with a single asset or sector. If that asset or sector takes a hit, your losses are magnified. Diversification can help mitigate losses when using leverage. Ignoring market trends can lead to significant losses when using leverage. Now let's delve into why this is the case. Market trends, whether they're bullish or bearish, provide valuable signals about the direction of market prices. When you're using leverage, essentially borrowing to amplify your investment, understanding these trends becomes even more crucial. Imagine you're on a boat in the middle of the ocean. The market trends are like the wind. They can either propel you forward or push you off course. If you're not paying attention to the wind's direction, you're likely to end up somewhere you didn't intend to be. In the context of leveraged investing, ignoring market trends is like ignoring the wind while navigating your boat. You could end up off course and in deep waters, metaphorically speaking. It's crucial to stay informed, study market trends, and use this knowledge to guide your leveraged investments. Ignoring market trends can lead to disastrous outcomes when using leverage. Emotional trading is another way people go broke with leverage. When our feelings get the best of us, rationality often takes a back seat. Fear and greed become the drivers of our decisions, leading us down a perilous road. The fear of missing out can push us to jump into trades without due diligence, just as the fear of losing can cause us to hang on to failing assets for too long. On the flip side, greed can make us over-leverage, taking on more risk than we can handle. Emotions also often lead to impulsive decisions and a disregard for a well-thought trading strategy. When using leverage, these decisions can magnify losses, turning a manageable situation into a financial disaster. Remember, successful trading requires discipline and a level-headed approach. It's not about making a quick fortune, but about consistent growth over time. Emotional trading can lead to significant losses when using leverage. Overconfidence can also lead to financial ruin when using leverage. In the world of investing, confidence is vital, but overconfidence can often be a wolf in sheep's clothing. It's when we start to feel invincible, when our previous successes mask the inherent risks of the market, that we tread on dangerous ground. Overconfidence can lead us to take on more risk than we can handle. We might leverage ourselves too heavily, convinced that our chosen investments can't possibly fail. This high-risk gamble might pay off once, maybe even twice, but it's not a sustainable strategy. The market is unpredictable and no investment is bulletproof. In the heady rush of overconfidence, we might also neglect to set stop losses or ignore obvious signs of market downturns, believing we're immune to the ebb and flow of the market. But remember, every investor, no matter how seasoned or successful, is subject to the same market forces. Overconfidence and leverage can be a dangerous combination, so let's tread wisely. The final way people go broke with leverage is through a lack of knowledge and experience. This is a pitfall that can't be overstated. Knowledge and experience are the cornerstones of successful investing. They are the shields that protect us from the fiery arrows of financial missteps. When it comes to leverage, the stakes are even higher. Leverage is like a sword that can strike a deadly blow to your financial health, if not wielded with skill and caution. It's not something to dabble in out of curiosity or to try your luck. It requires a deep understanding of the market, the ability to interpret financial indicators, and the wisdom to make informed decisions. Experience, on the other hand, is the best teacher. It tempers the theoretical knowledge with practical insights and lessons learned from past successes and failures. It's a journey of trial and error, learning, adapting, and growing. Without adequate knowledge and experience, using leverage can lead to significant losses. So arm yourself with both before stepping into the battlefield of leverage trading. So there you have it, the top 10 ways people go broke with leverage. We've delved into the perilous traps from misunderstanding leverage, overtrading, and neglecting to set stop losses to poor risk management and a lack of diversification. We've brought into light the dangers of ignoring market trends, succumbing to emotional trading, and the overconfidence that sometimes blinds us. We've also underscored the importance of knowledge and experience and how their absence can lead to financial ruin. The key takeaway here is that leverage, while a powerful tool, can be a double-edged sword. It can amplify your profits, but it can also magnify your losses. It's crucial to navigate the investment world with caution, wisdom, and a sound strategy. And with that, we wrap up this enlightening journey. Remember to subscribe to Investor Web for more insightful content like this. Stay smart, stay safe, and happy investing.